Risk is something that you can't see from the return numbers alone, and it's interesting to ask ourselves the questions like, was a deposit with Clico risky in 2005? Were internet stocks risky in 2000? You can't always see based on past experience or that which just came before what may be risky. Sometimes there are clues, and sometimes things just jump up out of the blue and you don't know that it was there. When we think of risk in investments, we'll typically think of two things. One is the permanent impairment of capital, and note the word permanent. The second is an inability to achieve your required rate of return, especially if you're a pension plan. That's a pretty big deal. So again, our job is we can't avoid risk. It's impossible to avoid risk or you won't make any return on your money. But the idea is to take risk sensibly. Here's a quick illustration using the S&P 500 of how those two risks can manifest themselves. This is a graph of the S&P 500 U.S. large capitalization stocks going back 1993 to now. You can see the top line, if you'd bought stocks back in the year 2000, not only would you have endured two 40% drops temporarily, but you also wouldn't have made back your money yet. So the typical human being would not have ridden it down and back up. The problem with 40% drops is they typically cause a lot of opportunity to buy high and sell low, which we all want to do that. So those are the two risks in one picture. A turkey would go through its life thinking that we humans are wonderful because every day it wakes up, it gets fed, it gets to hang out with its friends, and then about a week before Thanksgiving, our attitude suddenly changes, and we wring its neck. It's got a mistaken assumption if it thinks that we're its friend. Diversification is the one free lunch in investments, and that refers to the idea of spreading your risks, especially if they're not correlated with each other. All things that might have good potential returns, if you can put them a little bit in 10 things as opposed to one, that's a good idea. That will always cut your risk of something bad happening. As I mentioned, looking for value helps control risk, as does having a process to remove emotion where possible. So to summarize, basically, here we are in a center for creative imagination. I would say risk involves a combination of, or risk control rather, involves a combination of calculation and imagination.